All right, today we're going to do something really cool. We're going to decode the very blueprint of the financial markets. And I mean looking at these charts not as just random noise, but as a readable structure that tells a really compelling story about where the price might be headed. So let's get right into it. You know, if you've ever stared at a price chart, I'm sure you've felt it, that sense of confusion, right? Maybe even a little bit of overwhelm. You're just wondering, is there any logic to these endless zigzags, or is it all just complete chaos? And for a lot of people, that confusion leads to trading based purely on emotion. You know the drill. You buy because of FOMO, the fear of missing out, then you sell in a total panic. You get caught up in these huge waves of public greed and fear. And let's be honest, that is a tough way to navigate the markets. But what if I told you that underneath all that chaos, there's a blueprint, a repeating, structured pattern that once you learn how to read it, reveals the real story of what's actually happening behind all those price swings? See, this blueprint is written in the market's own hidden language. And learning this language? Well, that's the first and most critical step you can take. It comes before any trading strategy can even hope to work. And this is really the key takeaway right here. If you can just correctly identify which phase of the market cycle you're in, you've already done most of the heavy lifting. The specific strategy you use, that becomes almost secondary to understanding that much bigger picture. So, how do we start reading this blueprint? Well, we've got to start with the absolute fundamentals, the building blocks. You can even think of them as the atoms of price movement. Okay, so our first atom is what we call a swing low. Just picture it. You've got a single price bar, or a candle if you use those, that makes a low point, and the candles on either side of it, to the left and the right, both have higher lows. See that? It makes this little V shape. And that V shape? That's a temporary floor. It's a point of support where the price just for a moment has stopped dropping. And our second atom is the swing high. And you guessed it, it's the exact opposite. It's a candle that makes a peak with lower highs on both sides. This creates an inverted V shape, and it acts as a temporary ceiling, a point of resistance where the price climb has hit a pause. Now, these swing highs and lows, they're not just random events. When you start chaining them together, they form trends. An uptrend is just a sequence of higher peaks and higher troughs. Think of it like climbing a staircase. Each step up is higher than the last one. And a downtrend, it's the reverse, a series of lower peaks and lower troughs, just like walking down that same staircase. Okay, so now we have the atoms. Those are our swing points. And we have the basic molecules, the trends. So now we can zoom out and see the full architectural plan, the grand design of the market. And this is where it all starts to come together. And what this reveals is the entire life cycle of a market move. It's not a random walk at all. It's a predictable four-phase cycle. It kicks off with accumulation, then it moves into a markup or an uptrend. It peaks at distribution, and then finally it falls during the markdown, right before the whole cycle starts all over again. So let's talk about phase one, accumulation. The really crucial thing to get here is the psychology. The market has been in a downtrend for a while, everyone's pessimistic, the news is all terrible, and this is exactly when the large, informed institutions, what we'll call smart money, start quietly buying up assets at bargain bin prices, while everyone else is still scared. Now, after smart money has filled their bags, the markup phase kicks in. The price starts to form that clear uptrend we just talked about, higher highs and higher lows. And as the price rises, what happens? Good news comes back, optimism starts to grow, and the general public, who were terrified before, start buying in, which just fuels the trend even higher. Next up, phase three, distribution. This is basically the mirror image of accumulation. The market is euphoric. I mean, everybody is convinced prices are going to the moon. In this peak excitement, this is the exact moment when smart money does the complete opposite of the crowd. They start strategically selling the assets they bought way back when, selling them to the retail traders who are now piling in at the top, full of FOMO. And what follows that euphoria is the inevitable markdown. Once smart money is finished selling, well, there are no more big buyers left to prop up the price. The trend reverses into a clear downtrend, lower highs, lower lows. The folks who bought at the top are now forced to sell in a panic, and that just makes the price fall even faster, which leads right back to a state of despair, where, you guessed it, the cycle can begin all over again. This cycle really highlights a critical dynamic in the market, the totally conflicting behavior between the architects of the move, the smart money, and the crowd of retail traders. Let's really look at how different they are. Just look at this contrast.
It's stark. In the accumulation phase, when retail traders are feeling nothing but fear and apathy, smart money is buying. Then, during distribution, when retail is absolutely euphoric and buying with massive FOMO, smart money is selling. I mean, they are playing two completely different games on the exact same price chart. And that, right there, is the essence of the market blueprint.
So that all begs a pretty big question. What actually drives the price from one phase to the next? Why does the price move to those specific levels? Well, the answer lies in a concept called liquidity. The best way to think about liquidity is as the fuel that makes the market engine run. See, when these huge institutions want to buy or sell massive positions, they can't just click a button like we do. They need to find an equally massive number of opposing orders to trade against. And those orders, especially the stop-loss orders from retail traders, form these giant pools of liquidity. So where are these giant pools of fuel located? Well, they're clustered in really predictable places. Just above every single clear swing high, there's a pool of buy orders. Just think of everyone who bet the price would fall and put their stop losses there. And just below every clear swing low, there's a pool of sell orders, where everyone who bought has placed their stop losses. Every single trader setting a stop loss is basically adding fuel to these pools. Okay, get ready for this, because this right here, this is the big aha moment. Smart money isn't just sitting back and reacting to what the price does. No way. They often engineer the price moves themselves, and for a very specific purpose. To drive the price to those pools of liquidity, they need to trigger all those stop-loss orders to get the fuel they require to fill their huge positions. So here's how this liquidity sweep actually works. First, smart money will deliberately push the price just past a previous higher low. That's the bait. Step 2, this triggers a huge cascade of stop-loss orders from retail traders who were either getting stopped out or, jumping into a new breakout trade. That's the trigger. Then, at that exact moment, smart money swoops in and absorbs all of that liquidity to fill their own massive orders. And then, the final step, the price often reverses and reverses sharply, leaving all those breakout traders trapped on the wrong side of the market. So let's just quickly recap the blueprint we've laid out. First, the market moves in a predictable four-phase cycle. It is not random. Second, an uptrend is simply built on higher highs and higher lows, and a downtrend is the opposite. Third, smart money consistently acts opposite to crowd psychology. They buy in despair, and they sell in euphoria. And finally, and maybe most importantly, prices often engineer to move toward the liquidity, which is always collecting above old highs and below old lows.
So I'll leave you with this one question. The next time you open up a price chart, what are you going to see? Are you going to see a confusing jumble of random lines that are just driven by fear and greed? Or are you going to see the structure, the phases, the liquidity, the whole story unfolding right before your eyes? Are you going to see the blueprint?